Welcome to the Deep Dive. Today, we're digging into IFRS 16 leases.
That's right.
We've got the standard itself here, looking at its history, the key parts. Our mission really is to cut through the complexity, understand the core of the standard, and why it actually matters.
Yeah, IFRS 16 is basically the definitive guide now for how companies globally handle their leases. It covers everything: recognition, measurement, how it all looks in the financials.
And it wasn't always like this, right? There was quite a path to get here.
Oh, definitely. Before IFRS 16 came along in 2016, we had IS 17, plus a whole bunch of interpretations, SXS, IFRS. It was a bit fragmented.
So what was the big push for the change? Why overhaul it?
Well, the main thing was transparency for investors, really. Under the old rules, IF 17, lots of lease obligations, often quite significant ones, were effectively off balance sheet for lessees.
Ah, the old operating lease loophole, sort of.
Exactly. IFRS 16, issued January 2016, wanted to bring most leases onto the balance sheet, give a truer picture.
And it's evolved since then, too, hasn't it? It's not just static.
No, accounting standards have to keep up with the real world. We saw specific amendments for COVID-19 rent concessions.
Right, in 2020 and 2021. That makes sense.
Yeah, and then changes related to the big interest rate benchmark reforms in 2020, and another tweak for sale and leaseback liabilities in 2022, plus minor bits here and there.
So the core objective is still giving you, the person reading the accounts, relevant info.
Precisely. Relevant and faithfully representative information about leases, so you can see how they impact the company's financial position, its performance, and its cash flows.
Okay, let's break it down. For the company leasing the asset, the lessee, what's the main change?
The big one is recognize a right-of-use asset, that's their right to use the thing, and a corresponding lease liability, their obligation to pay.
And this happens right at the start?
At the commencement date, yeah, when the asset is actually available for them to use.
Are there any get-outs, any leases they don't have to capitalize like this?
Yes, thankfully. There are practical exemptions, short-term leases, sub 12 months or less, and importantly, no option to buy it at the end.
Okay.
And also leases of low-value assets. Think tablets, small office furniture, that kind of thing. They assess that based on the value when new.
And for those, they can just expense the payments.
Yep, straight expense, much simpler. Like the old operating lease treatment, basically.
Okay, but for everything else, how do they figure out the initial numbers, the value of this asset and liability?
Right. The right-of-use asset starts at cost. That includes the initial amount of the lease liability itself.
Makes sense.
Any payments made before the lease starts. Any initial direct costs they incurred, like commissions. And importantly, an estimate of costs to dismantle or restore the site later, if that's part of the deal.
Okay, quite a few components. And the liability?
The lease liability is the present value of the future lease payments.
So, discounted back.
Exactly. Using a discount rate. That's either the interest rate implicit in the lease, if you can figure that out, or the lessee's incremental borrowing rate. Basically what it would cost them to borrow similar money over a similar term.
Got it. And then, over time, these numbers change.
They do. The right-of-use asset gets depreciated, usually straight line, over its useful life or the lease term, whichever is shorter.
Okay.
Lease liability. Well, it goes up with interest, each period unwinding the discount, and goes down as payments are made.
And it can get remeasured, too.
Yes, if things change significantly. Like if the lease term changes, or if their assessment of whether they'll exercise a purchase option changes, or if payments linked to an index or rate change.
Right. And this all needs to show up clearly in the financial statements.
Absolutely. Presentation and disclosure are key. Lessees need to show the right-of-use assets and lease liabilities, either separately on the balance sheet or clearly disclosed in the notes.
What kind of details do they need to give?
Things like the depreciation charge, the interest expense on the liability, the expenses for those short-term and low-value leases, cash outflows for leases, any new right-of-use assets added, and a maturity analysis. That shows when the future payments are due.
Okay, that covers the lessee side pretty well. Now, what about the lessor, the one providing the asset?
For lessors, the first step is classification. It's a crucial distinction. Is it an operating lease or a finance lease?
And how do they decide? What's the difference?
A finance lease basically transfers substantially all the risks and rewards of owning the asset to the lessee. Think of it like a finance sale. An operating lease is everything else more like a simple rental.
Are there specific criteria?
Yes. Indicators include things like, does ownership transfer at the end? Is there a cheap purchase option the lessee is likely to take? Does the lease term cover most of the asset's economic life? Is the present value of the payments pretty much the whole fair value of the asset? Or is the asset very specialized for the lessee?
Okay, and the accounting follows from that classification.
Completely. For a finance lease, the lessor takes the asset off their books and recognizes a lease receivable their net investment in the lease. They then earn finance income over the lease term.
What if the lessor is also the manufacturer?
Ah, good point. Manufacturer or dealer lessors recognize selling profit or loss at the start, just like a normal sale, plus the finance income over time.
And for an operating lease?
Much simpler for the lessors. They keep the asset on their balance sheet, depreciate it as usual, and recognize the lease payments as income, typically straight line.
Disclosure requirements for lessors too, I assume?
Oh, yes. For finance leases, they need to show things like selling profit loss, finance income earned, and a maturity analysis of their receivable. For operating leases, it's lease income, details about the assets they're leasing out under IAS 16, and again, a maturity analysis of expected future payments.
Gotcha. Now, what about those sale and leaseback transactions, where a company sells an asset and immediately leases it back?
Yeah, those have specific rules.
Yeah.
First, you use IFRS 15, the revenue standard, to determine if the initial sale is actually a sale.
Does it meet the criteria for recognizing revenue?
Exactly. If it is a genuine sale, the seller lessee only recognizes the portion of the gain or loss that relates to the rights they've actually transferred to the buyer lessor. They also recognize a right-of-use asset for the rights they've retained by leasing it back.
And the buyer lessor?
They just account for the purchase, like any asset purchase, and then account for the lease as a lessor would, following the finance operating lease rules.
What if it doesn't qualify as a sale under IFRS 15?
Then it's treated as a financing arrangement. The seller lessee keeps the asset on its books and recognizes a financial liability equal to the transfer proceeds. The buyer lessor doesn't recognize the asset, but recognizes a financial asset, like a loan.
Okay, that makes sense. And briefly, you mentioned a temporary exception related to interest rate benchmark reform?
Right, that was a practical expedient. If lease modifications were needed only because of the reform, like switching from LIBOR to a new rate, companies could use a simplified approach, provided the change was economically equivalent, just avoided unnecessary complexity.
So pulling it all together, IFRS 16 was, well, kind of a big deal, especially for lessees.
Huge. It fundamentally changed the balance sheet for many companies by bringing most leases on. It provides a much more complete view of liabilities.
And the amendments show it's adaptable.
Exactly. It responds to real-world events like the pandemic or market reforms.
So for you, reading financial reports, understanding the standard is pretty crucial now, wouldn't you say?
Absolutely essential. If you want to accurately gauge a company's financial health, especially those in retail, airlines, industries that lease a lot, you need to grasp IFRS 16's impact. It affects key ratios, debt covenants, everything.
It really changes how you might analyze financial metrics and perhaps even how companies make leasing decisions.
No doubt.
Well, this deep dive gives you a solid foundation on IFRS 16. Something to think about might be, how does this focus on control really play out in identifying tricky lease arrangements? Or maybe what were the practical hurdles companies faced applying those COVID rent concession amendments? Lots more nuances to explore.
Definitely. It's a complex standard with ongoing implications.
Thanks for diving deep with Deepcast AI today. If you enjoyed this, give us a like and definitely subscribe and ring that notification bell so you're first in line for our next exploration.